Good afternoon, dear colleagues. I welcome you at the Central Bank. Thank you for responding to our invitation to take part in this discussion. We're discussing Leon Saak and the board member will present the outlook. Vazgen Pavosyan, you already know, Monetary Policy Department head, and will be joined by the macroeconomic policy expert Angela Popikan from the same directorate. Mr. Pavosyan will present the material, and then we'll have the regular Q&A format to proceed with. Thank you, colleagues, for joining us today. We'll start with the external sector. This is the logic we build a presentation, main locomotives of the economy. Then we'll talk about where the economy stands and will reflect on scenarios, illustrative scenarios, and policy decision, the way it was taken for this quarter. We'll start with the developments in the American economy, the economic growth in the United States, and the estimates about current growth are quite on a high level. On Q3, 3.6% is the assessment of growth, which is greatly contributed to increased consumption in the economy. Essentially, demand-driven growth still remains high in the economy, and the inflationary environment still is high in the overall economy. 12 months core inflation or sticky price, commodity groups changes in the goods and services. The most sticky prices they contain to be over 3.3%, bearing to some extent, I'm talking about general inflation, the gradual impact of the increased tariffs, custom tariffs is being felt. Subsequent impact of those tariffs will be greatly contributed to by the demand environment developments in the economy. On the other hand, if we look at the labor market developments, then we see that the labor market signals of weakening are getting more intensive within the recent months, which is visible both in the layoffs indicator or the level of unemployment, which got gradually to 4.5, 4.6. But we need to emphasize that notwithstanding the weakening of conditions, the rate and scales of this weakening are not to the extent that we could deduct weakening of demand environment in the American economy. Looking forward, reflecting on the risks and several scenarios, we need to emphasize that the uncertainty in America continues to remain pretty high, around neutral rate. If look at the lower left graph, this is the Fed recent decision, their published interest rate and expectations curve of the board members. What's remarkable here, if we look at the long term, at what the members of the Fed expect the policy rate to be formed around, notwithstanding the median being around 3%, but the spread is quite broad, and the spread is towards increase. The uncertainty is great in midterm, long-term, neutral percentage interest, and the spread is towards upwards. Even 4% environment, there is more spread than in below the 3 domain. There is more above 3 than below 3%. If we talk about the risks as well, let's say the fiscal policy and uncertainty around it continues to remain high. Their famous OPPPA, which assumes in the long term fiscal policy expenditures expansion and significant increase in the midterm of deficits. The amount and the size of this deficit and respectively the Debt curve uncertainty is quite high, which may impact the neutral rates in the long term, depending on what would be the fiscal incentives and what would be the curve of the. There could be additional impacts on the levels of neutral rates. Uncertainty remains high also in migration policy and its impact on the economy as well. Migration policies are quite tight in the US. The lower right shows the number of arrests and detentions, as well as the border crossing numbers, which are gravitating towards zero already since early 25. And the uncertainty about its impact on the economy is also quite high. Another source of uncertainty in their short-term and mid-term growth perspective, it's the uncertainty about prices of financial assets and the prospects thereof. In the right top, it's cycles adjusted price return PE ratio. We see that although there were adjustments of late, the price of assets continue to remain pretty high, even in the 2000s dot-com crisis, comparable, close there too. And there are other signals here as well, contesting to overpriced financial assets, and the possible adjustments of this may also have an impact on the American economy. So if we look at the uncertainty about the US general policy, the dilemma of the Federal Reserve in the short term is quite high. The inflation continues to be high in several sectors of the economy. There is a contribution to the formation of the high inflationary environment. On the other hand, there are short-term and mid-term risks that may result in substantial weakening of the economy. There are long-term risks about the neutral rate, and they significantly increase the Federal Reserve policy dilemmas. In these conditions, the Fed, in its recent lowering the policy rate, talking about the future, essentially reflected on far more gradual lowering policy going forward. Only once in their assessment in 26 this will happen, and it will go on like that once or twice in the midterm as well. But as I mentioned, the uncertainty about the path of the interest rate, considering all these scenarios and factors, is quite high. Eurozone economy, we essentially do not have great change compared to the previous iteration. Q3 growth is pretty slow if we look at quarterly comparisons. A slight acceleration exists mostly in services and similar sectors, but the structural issues in the economy, long-term structural problems persist. So the processing industry, general industrial issues and whatnot, as you see here, for example, investments continue to be quite weak, remain, and so forth. On the other hand, the labor market, one may say the conditions are quite tight. The unemployment level, notwithstanding, within recent months it weakened somewhat, but the conditions continue to remain tough. From the historical low, it has slightly increased to 6.4, and the wages, irrespective of certain weakening, they're on a lower or more sustainable level, but their inflationary pressures from the labor market still noticed, especially from the certain sectors of the economy, services in particular. Inflation continues to be high, not only high, but within the recent months. If you look at the top right graph, the services inflation has even accelerated slightly. Is from 3.1, it's already reached 3.5. The services inflation. This is also a matter of concern. ECB policy developers have observed the certain rollback in their communications and sent several signals about the possible increase of the interest rate going forward. The other factors, the main source of uncertainty is the fiscal policy, especially security in infrastructure, investments, big packages, implementation time frames have uncertainty, which could have provided the additional incentive for employment, and with inflationary pressures could have sent a signal. Russia, our main trading partner, essentially, we see economic growth normalization within the recent period, especially in the previous quarter. We see continual rapid weakening of the growth. This may be an indication of a rapid weakening of demand or conditions, which is reflected in the lending levels. The growth rates are rapidly over the last year gradually decreasing. But here the signals are somewhat different. If we look, for example, at developments in October of the economic activity indicator, in October we had some growth shocks or acceleration, both in retail and services, especially in processing industries, which is also reflected in lending indicators in October. There is a certain acceleration, quite rapid, but we need to understand over time, was this a sporadic one-time budget commission or a more midterm or other factors which may persist longer. In general terms, in the economy, the slowdown trends continue, and there is an additional negative impact on it, and essentially that will take place. The toughening of sanctions. You may recall the Lukoil and Rosneft individually being sanctioned by the United States, and in the lower right graph you will see the Russian oil discount that it sends against Brent. Several years ago it was almost zero. Starting with 22 it got larger, and it's $12-13 of late. In the wake of the sanctions it got down to 26, the most recent data. There is unpublished information that it may reach even, the discount may reach even up to $30, 25-30 against Brent. This may both affect the overall investment climate or consumption demand, and especially financing of budget expenditures. In particular, this may be a serious issue for the Russian economy. On the other hand, in Russia, we continue to observe conditions in the labor market remaining quite tough, although there is a certain weakening. The left graph shows the real wages increase in the Russian economy, whereupon the overall real wages growth in the overall economy is 4.7, around 5%, which against Russian historic level is quite high, but lower than the recent years. There is a certain weakening trend visible here, but the conditions are still tough. The inflationary environment as well, if you look at the right-hand side, is The 12-month inflation goes down rapidly. It's around 6.6% currently. But if you look at the momentum of the current developments of inflation, the monthly or even weekly inflation, which they publish, it's close to zero so for several weeks, the weekly inflation, which may also attest to the weakening demand. This is in our economy, from the perspective of our economy, an important factor or important signal which essentially needs to be considered. In China, economic growth continues to persist in their stipulated target, somewhat less than 5%. It's about 4.8, and this is mostly determined by external demand or exports. Their industry and exports are the main drivers of the economy, whereas in their case as well, the structural problems persist. In the right hand side, if you look at this top right graph, the cumulative investment in the economy year-on-year growth curve. Although in 24 already the investments were pretty low, this 3% growth for them historically is quite low. Usually in the contributing factors to the economic growth, 2.33% contribution was accounted for by investment. This contribution is around 1% currently, or even less. And here you will see also that in the right graph, that especially in recent months, May to June, may be also determined by trade policy uncertainties, the relations with the US uncertainty. There is a weakening of investment. January to October is already negative over previous year, about 2%, by about 2%. This is important in the terms of long-term economic development, or to properly interpret the sentiments in the economy. On the other hand, the certain problems that were determined by deteriorating relations with the US and uncertainties about trade policy are to some extent being addressed and resolved, because they succeeded in quickly reorienting Chinese economy to alternative markets. In the lower right graph, you see that the trade balance with the US, these are the trade balances, is deteriorating. With the EU, it's more or less give or take the same, but other countries, especially Asian market and other countries, are quite rapidly growing. So they succeed to rapidly diversify, find new export markets. And here, for us, there are certain risks of inflation. The producers' prices are negative year-on-year, -2.5% growth. And if they reorient markets and maintain somewhat more aggressive policy, usually they enter new markets through dumping, there will be certain inflationary pressures and risks from that side. Commodity market developments, we see both oil, there is no big news here. The oil prices continue to go down with the gradual lowering of the global demand and increase of supply, but midterm risks, both upwards and downwards, there are essential risks. And in conditions of this great uncertainty, the volatility both in the oil and other commodity prices maintained. As for commodity prices, from halfway through the year, there were certain impacts and signals inflationary. If you may recall, during one of our previous rulings, we talked about August-September year-on-year FAO food prices accounted for 6% in the global economy, and by the same token, the Armenian imported Food basket growth was 6.5%. Within the recent years, we see a certain weakening in the global food market of inflationary influences. As of November, year-on-year FAO index growth hovers around -2%. So we could expect the impact on us to weaken, or even going forward some price reduction effects from there. Talking about the prospects and uncertainties around this continue to stay, persist. There are supply factors mostly, as well as global demand uncertainties remain in place alongside other factors arriving. As for our economy, let's talk about the risk premium of the country. Within the recent months, we saw our Eurobond spreads, which we measure comparing the interest with the non-risk assets. We saw the spread significantly reducing. If we look at the right-hand graph, the yellow curve is Armenian Eurobonds spread compared of the same maturity comparing to fiscal paper. So there were about 200 base points. Now it's a little above that, but it's still quite low. And here the main question was the extent to which this reduction is determined by intrinsic Armenian factors and the extent to which it was determined by overall developing countries' trends. If you look at the right-hand graph, the blue line is the overall developing economies weighted average spread for all developing countries. Usually we are pretty close to this curve of developing country trends. And we see that as of a certain point in time, especially after the events of August 8, we are somewhat below the curve of the overall developing countries trend. Through using some econometric toolkits, we tried to see as of August 8, what's this amount? It's about 20 base points, 17 and a half, this side of August 8. So we are somewhat below the overall developing countries curve. If we look at the future, to understand long-term risk premium of the country, where is the sustainable level of it, the uncertainty around it is quite high. This is one of the big sources of uncertainty in the current period that we are observing. There are several scenarios that could be looked at. Here, this essentially depends on the developing countries trend that we see here, this declining trend. How stable it is. Will it persist long or not is determined by structural transformations, which we see substantial developments in developing countries, both in fiscal and monetary policies, toolkit development, but improvement in discipline and other lines. Weakening of the debt level, as well as we observe that the adverse trend in developed countries, rapid growth of debt and whatnot. The important question here is these trends of reduction of developing countries, whether they are fundamental and will persist. Shall we remain around these 250 base points, or they are temporary factor, for example, the financial weak conditions in the global markets, high liquidity level, and etc., which overflows to developing countries as well. And if this environment were to change, maybe they have to be adjusted and roll back to the previous 340 or even higher base points. So the uncertainty here is determined by the longevity of the factors and their structural fundamental nature. If we go to the economic growth in the internal economy, domestic economy, we see that the economic growth continues to stabilize around 6.2% in our economy, which is somewhat higher than our market long-term sustainable growth level. It's somewhat higher, and if this current growth, if we look at Q3, this is mostly contributed to by services, in particular IT, ICT, financial sector, as well as construction. These continue to remain the main contributors to the economy. And if we look at the current trends, let's say the indicator of economic activity within the recent months, it has accelerated somewhat towards double-digit levels, especially in September, October. In October, there was 10.1% economic activity indicator, but what we also see here is that this growth is to some extent, if you look at the structure, you see a big growth in processing industry, especially in September and October. In October, it was about 20% the growth in processing industries. This was significantly contributed to by the base metals sectors, which essentially have little relation to overall development of the economy. One may say that they are non-structural factors of growth, essentially temporary, and the base metals year on year, it's 130% growth that year on year was registered in October, which greatly contributed to the 1.8% growth in the processing industry. Nevertheless, even if we purge the impact of non-structural factors, the economic activity indicator growth or acceleration is pretty solid and high level 6.9 or around it. Give or take in various months, it is maintained. Naturally, the other contributors were services and construction, which remain. If we look here at other substantial factors contributing to growth, and this is one of them, ICT, which is exportable. We, for quite a long time, when we were talking about it, we said that the uncertainty here is quite high. The high growth persists, but on the other hand, we do not see wages or employment increase here. Or if we look at the transformations in the IT sector, they are not such that could contribute to the higher rates. But within the recent months, we have observed certain signals to acceleration of healthy growth. In October, ICT year-on-year growth contribution was 28%. There was acceleration in the general economic growth. On the one hand, if we look at non-residents established, incorporated new companies, individual entrepreneurs in the lower right. The orange is the new IT enterprises established thereby. Although compared to 22-23, they are low, but over beginning of the year there is clear acceleration and certain growth in incorporating new individual entrepreneur businesses. September, October, and November, the transformations, the Exchanges, banks acquiring forex in net terms have increased. So here we will see this is also attesting to potential growth in the economy. There are certain signals visible here. As for processing industry, as I said, the main contributor within the recent month were base metals, but some certain individual sectors also contribute, like chemical industry and what not. Food industry also. If we look at the left graph, if we purge this 20.8% from the impact of non-structural factors, the growth remains in the balance quite modest in the processing within those 3 months, of around 3%, more or less. And looking, may I ask a question? Well, let's save the questions for later, unless you mind. Let's agree. I'll try to go quickly through this and then we'll. On the other hand, if we look at the levels of exports and the markets, the main sectors and subsectors of processing industry, we see that they continue to grow quite healthily and remain high. But when we look at the sources of the processing industry export directions, we see that almost for all groups of goods, with the exception of tobacco, the dominant destination is Russia. And the weakening of demand and incomes there could have naturally certain risks for our processing industry. On the other hand, looking at the economy, especially those sectoral developments which are mostly accompanied by expanded demand, for example, in construction, the developments, the high growth still persists. In October, about 20% annually. But on the other hand, the prices are naturally being gradually adjusted. There is year-on-year weak fall in prices in the city of Yerevan, and in the provinces the high growth still persists because the withholding tax return program still is effective there. If we look at mortgage loans issued there, here again the developments are weaker in Yerevan, and the developments shift mostly to the provinces gradually. The weight of Yerevan is still substantial and quite big. But here again, this gradual real estate market and construction natural weakening essentially may be expected. In conditions of this weakening, overall, other ancillary sectors growth weakening and overall demand weakening in the general economy risks still persist. In the services, as I said, the main drivers of growth is financial services and ICT. Within the recent months, we also see some services, some subsectors growing more steeply. For example, administration, management, professional services, professional and business services growth, which essentially are also cyclic, following the overall economy cycles in dynamics. And here along these sectors we also see certain acceleration, but the overall concentration remains along several small sectors. The other sectors of the economy, essentially half or two-thirds of the economy, does very weakly contribute. or doesn't contribute at all to the overall economic growth. In terms of external demand, gradually moving towards the conclusion, we need to understand that the normal levels persist. Financial services exports, IT, and whatever goods exports remain, especially if we look at tourism developments, although through this year there was quite volatility. In tourism development, there were individual months that sent contradictory signals, but if we break the year into two segments, from early year to April, there were local falls up to 10-11% cumulatively, but there was certain rebound thereafter. If we look at May through October, then there is about 10% or 8% increase growth, if I recall correctly. And again, although it's mostly Russian tourists that contribute to this growth, we also, in this tourist flow, observe certain diversification. Asian markets have great influx. China, Japan, South Korea contribute. But Russia continues to be the main source and driver of our tourist flows. And the weakening of growth and demand in the Russian Federation may also result in certain risks for us. To understand the overall demand environment, if we look at the situation this way, we have long-term potential. We are somewhat above the forecast, 6.2 current. If we look at more current indicators, economic activity, will see even higher numbers, around 10%. The drivers of this growth contain some non-structural components. If we deduct them, the current activities indicator hovers around 6%. Uncertainty is quite high here, and from the monetary policy perspective, it's essential to understand where economy stands. What's this growth? Is it supply or potential driven, or is it demand factors driven? And here, most probably, one of the biggest sources of uncertainty in this quarter was the current position of the economy. If we use a technicality, where is the gap in the GDP? Is it positive or is it negative? And there are factors, essential factors here, which may attest to the fact that demand conditions in the economy are high, including professional services, which within the recent months is accelerating, or management services, certain subsectors which are especially in the recent period accelerating, or is it still high demand for lending? We see that the consumer lending in particular is still maintaining high growth. This may also attest to high demand environment and conditions in the economy. On the other hand, when we look at other factors, other important factors, they also could attest to the opposite, that the demand conditions are already weak in the economy and there is a certain reason to be concerned. For example, if we look at retail trade indicators, which within the recent period have gradually weakened and lag behind the economic growth or economic activity level. By the same token, if we look at imports, overall imports numbers are quite high, but if we deduct from it the imports of capital goods and final consumption goods for our own consumption, within the recent months there is certain decline. Final consumption goods, there is about a 10% slump, 8.6, and the capital goods as well. And what's most important, within the quite long recent period, in the wake of 22-23, especially second half of 24, our services and especially non-exportable sticky prices index, which is a good indicator reflecting demand and inflationary expectations environment in the economy, continues to be below 2.5%. If from the services we purge air transport, which the price discovery doesn't happen in our country for, then the services are on a very stable low level, 2.53%. These are also the factors which may attest to the fact that the demand environment in the economy is weak and we deal with constrained demand. From fiscal policy perspective, if we look at the year is almost over, at the tax collection and expenditures, the implementation is quite high compared to those years. On the right hand side, it's 21 to 23, where the performance was good, whether on current or capital expenses. On capex, we have historical under performance, but both revenues, if you look at the left hand graph, over the 10-month published approved results, we are quite in tune with historical trends and our essentially planned indicators performance. The risks are already quite weak. The scenarios and ancillary risks that existed in the economy, especially inflationary risks that existed, have substantially weakened in this current stage. But naturally, especially for capital goods and capital expenditures, within the recent months, there is significant big expenses. Historically, about 35% of overall capex is usually implemented within the last months of the years, and here there is still quite a lot of uncertainty as to how much capex will be delivered this month. But overall, the year is almost closed, and we could conclude that inflationary risks have substantially weakened. On the other hand, if we look at next year, 26, we need to factor in several things. The first is that fiscal policy is embarking on a consolidation stage, which is very important. For this year, 5.5% deficit was planned. Essentially, we'll see how much it will become, maybe somewhat below that. Then for 26, we already planned about 4.5, following 3.5, gradually moving towards 3, and even lower than 3 environment for next year. One may expect, if the indicators built into the budget are delivered as planned, the impact may be expected to be restraining on the economy. It will have a negative impact on demand by about 0.7%. Naturally, there are certain risks here as well, both upwards and downwards, and we look at those possible impacts along scenarios. In scenario 1, it's the rationale that once again taxes in GDP indicator will grow and tax revenues will substantially increase, but there are certain risks which, if materialized, may result in under collection of public revenue, whereas if all of the expenditures are implemented, including the reserve fund, it may have a weak inflationary impact on demand, 0.1% on demand. By the same token, if scenario 2 materializes, 1, 2, and 3 scenarios are different from the 0.7 by the rationale. In the second scenario, we assume the rationale that notwithstanding a certain reduction of capital expenditures, if in the capex structure uncertainty still persists, if the reduction of this capex is determined by the expenditures that do not have a direct impact on the economy or the industry, there may be 0.4 impact. And scenario number 3 has the logic of essentially historically underperforming capital expenditures. The logic of this scenario is that whether the capacity of the economy will be sufficient to implement about 6% capital expenses in the economy, especially if there are transformations in the capital expenses structure. For example, some of the defense expenditures are reoriented towards school, kindergartens, and other similar expenditures, which demand more construction capacity in the economy to be implemented. So whether the risks of underperforming increase here or not, this scenario, if it materializes, may have a restraining effect on the economy. On the other hand, if we look at the labor market developments, although the uncertainty persists here as well, there are basically two sources of statistics: the SRC, which is offering the formal de facto registered employees number, where we have big growth here. On the other hand, we have our statistical committee surveys, which also are the source of evaluating unemployment indicator. Within the most recent long period, it doesn't show any growth in employment. So the uncertainty is whether the demand for workforce is high, or is the SRC indicators simply testifying to the transition from the informal to the formal registration of the workforce. The unemployment is around 12.5%. On the other hand, the most important thing we look at is the wages, and we see that they are stabilizing. If we look at general wages, average in the private sector is about 4.5%. On the average, 5 to 6 in the most recent. If we deduct IT and financial sector, it's 6.5% in the rest of the sectors, which could attest to the increased wages and that we have non-inflation, neither inflationary impact from the labor market, and essentially this could attest to the equilibrium in the labor market, and overall the equilibrium being close to the overall economy level. As for developments in the inflation, if we look at 12-month inflation, within the recent months we were talking about certain supply factors that have contributed to one-time or short-term upwards curve. Some of it was neutralized already in November.
For services and for services inflation excluding air transport is actually a bit below target. But what's also important here is to pay attention to the quarter-over-quarter inflationary trends. Right-hand side chart, see speeding up, see an acceleration here. But it's important that in natural inflation, if we see it speeding up, we also have to consider that imported non-seasonal foodstuffs are included, which are also related to FAO, and here FAO is now in a deflationary environment, and it's weakening now. If we're looking at services, the non-tradable rigid price index, the last point is this 4% quarter-on-quarter annualized growth. It mostly reflects the month of September. Education, so it's one-off. It's the September revision of tuition, which is still driving an impact over these 3 months. There was an about 8-month revision. Besides, in October and November, the month-over-month inflation for non-tradable rigid prices was 0. But nothing major here. But of course, the central bank continues to monitor the situation, and we're very careful to the current inflationary trends. But on the other hand, if we're looking at the qualitative indicators that show the inflation expectations, so these are our surveys, the wage developments in the private sector and the non-tradable rigid price index developments, or our direct surveys among households could indicate that inflationary expectations are mostly stabilizing around our inflation target range. Turning now to the current position of the economy with all these developments in mind, one could assess that the economy is generally close to equilibrium, quite close to equilibrium. In technical terms, the GDP gap is close to neutral, slightly positive, perhaps around 0.2, 0.3%. As to the policy position, again, one could assess that our policy interest rate is close to the neutral interest rate. Given all the aforementioned developments in the economy, there is no major gap here. Maybe a neutral interest rate is somewhat below the policy interest rate, but then it's especially worth mentioning that around all components of the neutral interest rates, there's very high uncertainty about the US's neutral interest rate, as I said in the beginning, or high uncertainty in the country risk premium, or high uncertainty with the appreciation trend expectations for the economy. Fundamental trendic appreciation of the economy could be expected for the national currency, and also high uncertainty in terms of the inflation expectations. So for decision making, or for your judgment, from that point of view of the neutral interest rate, the uncertainty is quite high here, and it lingers and it survives. So that's something I talked about already. Uncertainty is high in the economy with the trend appreciation of the real exchange rate. And if you look at the right hand side, It's true that it's the nominal expected drum appreciation or depreciations as per surveys of the financial market participants. The gray lines there show also the impact of the great uncertainty among the financial market players, great dispersal between the players, but relative to earlier expectations, the exchange rate depreciation expectation is somewhat lower. But regarding the trend of appreciation of the real exchange rate, that left-hand side chart moving downwards is appreciation. So you can see here, you can assess now that for the exchange rate position too, we're close to equilibrium, but the uncertainty is whether the where trend appreciation is, where's the real equilibrium exchange rate. Because recent developments have led to different interpretations, such as how fundamental was the recent growth. Were there short-term factors there? Had these short-term factors all been neutralized? Are they still lingering or not? So those are the questions there. Turning now to the market expectations. There aren't really major differences. The dotted lines here, the ball line, right? Is the new survey, the newer survey. No big difference there. The logic being how we understand the market. If I were to try to explain the market scenario, here's how we understand. The market also considers that the economy, that's low left-hand side, the economy and economic growth are in long-term stable, close to long-term stable equilibrium position, will gradually decline, stabilize around 5%. And similarly, the inflationary developments, the market expects there that again, inflation is currently a bit above target, but will gradually move towards, or is gradually moving towards the inflation target. So it's mostly driven by supply factors rather than anything else. The right-hand side charts, you can see that the market perhaps considers that neutral interest rate is a bit lower than our current policy position, and it's expecting that the central bank will gradually, very gradually, or in small steps, reduce the policy interest rates close to 6.25% in the midterm, with which the market considers that it's possible to expect small depreciation, and that also equilibrium would be created there. Coming now to the current surveys in the market, the latest ones, we call them short surveys, right before and after the decision. The survey before the decision, that is among dealers. These surveys also show that for the next year, the market players are again expecting gradual lowering of the policy interest rate towards 6.25, but you can also see the dispersal here, according to the financial market participants. The big dispersal upwards and downwards, we have players here reporting this. And if we turn to the yield curve developments, because in terms of assets, financial markets assets, this is key. Recent significant declines are observed in the yield curve in our economy, and this refers especially to the medium-term and long-term segments of the curve. And a number of factors grouped up here that could indicate all this. Primarily the factors that are structural the economy's estimated growth potential with some recent revisions. The IMF, for instance, revised it from 4.5 to 5, and other impulses that the growth potential is seen by some players as being somewhat higher, and our fiscal sustainability. And from that perspective, we're in better conditions. The deficit is expected to come in lower than the planned 5.5%, and especially in the midterm, the plan is to have consolidation carried out. And this, combined with robust growth, leaves the sensation that in the midterm, the debt trajectory is going to be much lower than could originally have been anticipated. Another factor here is, of course, the reduction of the inflation target by the central bank from early on in the year, and we see that as a result, the financial markets and generally in society, the inflation expectations continue to decline and stabilize at around new targets. The country risk premium factor, short and mid-term, and the impact of monetary policy gradually transferred. There was also this reducing the mandatory requirement for reserves done recently. Additional liquidity was recently injected into the financial markets, which, we could put it this way, could speed up or be a trigger for faster adjustment to the structural factors and the new things. This is the place where we want to hear you and hear your perspectives. 100 base points for the reduction. I'll quickly summarize the A and B type main risks and the scenario tables. I'll go faster. If you look at the greater demand risks, the first scenario was in the US with fiscal policy, higher than expected deficits. Neutral interest rates could climb up in the US, and not just in the US, but also in emerging markets. And here, if we fail to take all that into consideration, we'll be in a much more stimulating position, stimulating demand, expanding demand. Then on the other hand, uncertainty related to the Russia-Ukraine conflict, the lingering of this conflict can be a source for speeding up or maintaining capital inflows to Armenia, feeding demand and contributing to inflation or having an inflationary impact. And next, international food markets. Rising food prices, which in Armenia too led to higher foodstuffs prices, in line with international price increases. Under this scenario, this could somewhat influence inflationary expectations, unnecessarily accelerating and create subsequent risks of higher inflation down the line. The next thing is somewhat loosening of the regional geopolitical situation, which can be a cause of accelerating capital inflows to Armenia, expanding demand, contributing to inflation. The next category of factors about expanding domestic demand or being at high levels and potentially expanding again in the future. For instance, that for a long time now, the growth sustaining at above longer-term potential, and which is also a result of primarily demand-driven sectors. It could point to excess demand conditions in the economy. The next thing is that savings, accumulated savings in the country in recent years, not structural, partly short-term factors, and the high incomes driven by them. With declining uncertainty, they could be channeled at consumption or amplify aggregate demand in the economy. The next one is tourism. We're seeing recent increases in tourist inflows, and if they sustain, again, there may be additional inflationary pressures there. The next one is fiscal policy, the fiscal stance, that with the undercollection of tax revenues or overspending being more expansionary could contribute to inflationary pressures. The next category of scenarios are contractionary, demand contractionary scenarios, which refer to the global economy mostly, and they're transferred to Armenia. The global trade wars or trade conflicts or escalating policies between the lead economies. There could be disruptions in the global supply chains or risks of such disruptions, which could generally have an inflationary impact in the global economy. And the other scenario, the accumulation of stagflationary risks in the global economy as a result of the current policies, maybe not yet fully anchored, or maybe higher inflation expectations in the top economies. They could create risks of general global inflationary environments. The next category are the B-type considerations, B-type risks, and the first category here, the subdued demand scenario factors, the one in particular in the EU and in China. The lingering weak demand in the Eurozone and China, or further weakening of demand in those environments. The next one is prolonged elevated uncertainty in the US, especially with regard to economic policies that could lead to a confidence crisis. And such negative scenarios in the US. The next one is financial assets being overvalued. That scenario in the US and the likely adjustment and the impact of it in the global economy, on the US economy, on our economy, in the Russian economy. Demand conditions and real income sharply weakening, sharply dampening impulses, of which we're seeing already, and I presented them to you. This is really a new scenario that just was added to our scenario table this quarter. And of course, the impact on Armenia here is important to understand. The risks and uncertainties emanating from this scenario. The next one is, in the event of settlement of the Russia-Ukraine conflict, the uncertainty regarding that, basically. So whether or not there is resolution and the conditions of a deal, conditions of the resolution. There could be significant risks there. In particular, the full or partial lifting of the sanctions from Russia could lead to a capital outflow from Armenia, deteriorating the demand environment and creating some inflationary pressures. Then the next one, persistently low inflation in services and non-traded sticky prices, and the slowing down of retail trade and final consumption goods imports, which could indicate that there's already a weak demand environment in Armenia this quarter. This is the illustrative B-type consideration that we'll present. Next up, in construction and the real estate market, gradual adjustment and the negative impact on the related branches. There are also scenarios with regard to the tax administration becoming more rigorous, tighter, and some risks materializing, investment or consumer behavior, and so on, and demand contractionary risks. The neutral interest rates of ours and the lingering uncertainty, quite high uncertainty, some downwards uncertainty scenarios. These recent strong increases perhaps were accompanied with significant growth in industrial capacity, manufacturing capacity, which was high productivity growth. It's that scenario. For a small open economy, capital inflows and fundamental appreciation expectations that could lead the exchange rate, neutral exchange rate, down. This risk also, a similar risk is the cooling of regional geopolitical tensions. And when I speak about the risk premium, and I did speak about it a bit, that the country risk premium could be revised downwards, with the neutral interest rates also moving downwards. Then, on the other hand, for expanding supply considerations, we could say that with a scenario of growing labor force, and board members have pointed this out, it's also related to the tightening of migration policies in Russia, the uncertainty in the medium term in Russia, it's quite high. So it's also that part. Whether these flows from Armenia to Russia will weaken. They will weaken, and labor force will grow. Labor force numbers will grow according to the expectations. Then the other one is faster than expected. A sharp slowdown of demand in Russia could lead to a situation where our agriculture output or the processing industry would mostly stay in Armenia and create surplus supply with deflationary impacts in Armenia. Turning now to the illustrative case A and B scenarios, we need to say very briefly our two quarterly scenarios. And basically also you could see here our new framework's beauty, if you will, which allows to consider all perspectives and not only one consensus perspective on the events, but the contrary. The wealth of that whole discussion and enables to communicate with financial markets and the economies and society are two scenarios in this quarter have to do with the current position of the economy, where the economy is A-type scenario. In the A-type scenario, we have these considerations that we just discussed that indicate that the demand conditions may be high, but for the B-type scenario, the considerations are on the contrary, that, as I told you, the factors that I described for imports of end-use products being weak or weakening retail trade, the persisting low sticky price index, and these two scenarios, if you look at the right lower middle chart, the GDP gap, it's about that in recent quarters there are some impulses and factors that can show surplus demand in our economy, and there's the other side as well of the factors which can show the opposite. And you can also see the policy response. And as a result of all these scenarios, not these two scenarios, but all of them, discussing all the scenarios, all the economic developments, in accordance with the market expectations, the board decided to reduce the policy interest rate by 0.25 percentage points. This is all on me. Thank you, and sorry if it was a bit long. Thank you. Questions? Please introduce yourself. I'm Petros from Agba Bank. Going back to US's trade policy. And we link it to the industry. Armenia is also affected by these tariffs. As far as I know, there's about a 10% tariff imposed on the industry, on the mining industry in particular. For this part, of course, we're talking about the processing industry, but mining as a potentially traded sector. What are the risks here? What risks are we seeing here? Great, dear Petros. If I'm not mistaken, in our June inflation report, or in March, we had a separate insert The first one is our exports to the US are quite small. 50 to 60 million a year. It's a small number in our economy. For the goods that go to the US, America is not the only market, or is not one of few numbers. They should not have big problems for diversification. One category, or aluminum foil. We had this precedent in the past. In the past, the sanctions were imposed on some countries. they could neutralize and diversify with limited losses. Minimum 10% tariffs were imposed on everyone. We're staying in similar positions in terms of exports. In some categories, we're in better conditions. In terms of competing countries, we're not competing in terms of volumes, but for other countries, which importing India and others, for them the tariffs are much higher than ours. There's uncertainty for what would happen there. The impact will be quite small. The impact on that policy will be very small on us. Arzuman from Ameriabank. We saw the central bank board members were not unanimous. When I was talking to other market players before coming here, I saw confusion or uncertainty in the market. I'll present the first group and the second group of the market players. The first group are those players who think that after a long pause, a 0.25% reduction, and again, of course, taking a pause, is not of significance for the real economy. And I'm going to try to ask you to substantiate why that step should be taken. I understand very well that 0.25 is understood as one step. We borrowed it from developed countries. 0.25 is considered as a one-step reduction. But there are major differences in Armenia in particular. Even the base level of the interest rate is much higher than in Europe, in the US, and so the relative impact of a 0.25 reduction in the US and in Armenia is very different. The second thing is the mechanisms of transfer to the economy are a lot less effective here than in developed countries. And I want to get your opinion here. Don't you think that in terms of the perception, it's better to consider the 0.5% reduction to be one step, not a 0.25%? And the second group of the confused are thinking that if this is anyhow 0.25 as a step and it's going to be continued, then it implies that the central bank, in its earlier statements when it was claiming that the current policy rate is neutral or close to neutral, which is sufficient for balancing currently inflation and the heated economy risks, is thinking that it should be sustained, it should be continued. So with this, is the central bank giving the impulse that potentially there are risks? The central bank wants to make a transition from neutral interest rate to a guiding policy. How do you substantiate this? Because if we look at it, we see in terms of the economic activity indicators and inflation, and natural inflation higher than last month. It doesn't justify that. Thank you. Arzuman, right? That's your name. We took it down right. I'll now try to answer your questions. Of course, a number of sub-questions in your question. So let's start with the following. What is a 0.25% reduction? And as you interpreted it, does how should our market perceive this? Is it the start of a series of reductions or not? For quite a long time, we left the policy rate unchanged. And from that point of view, our judgment was that in each cycle, for different reasons, we've tried to balance, and as we manage different types of risks, we decided to keep it intact, keep it unchanged. So it's not that everything is great, everything is fine, no. But under a new concept, under the new framework, unchanged could also mean managing the A-type risks, it could also mean B-type risks management, it could also mean getting closer to the market expectations scenario. So from this point of view, in this cycle, in the board discussions, we've come to understand that balancing the risks, the equilibrium of the risks, and their potential impact on the scenario has come down, become more balanced. Now with the data here, we have a chance now to take this step. But it's important to emphasize here also that if we look at the market expectations, because you're also taking part in all that, it's not a surprise for the market. It's not a surprise to the market. As to the theoretical step, the size of the step, I think that shouldn't be our perspective. That's not how we should take a look at it. It's not only the size of the policy interest rate change. It can also work in a number of other ways. It can also be oral communication of your expectations, a lot of other things. So when you talk about the interest rate and there's a scale there for the percentage change of it, it's a very dangerous journey. We would be oversimplifying, getting in that oversimplification problem. Yeah, the monetary policy reaction is what matters. It would be roughly the same. The monetary policy experts 6.5 to 6.25, but the reaction would be, oh, but it's so small. It's not the most rational avenue. It's the most illustrative scenario. If I may. Osman, is there anything else from your questions? I'll briefly respond regarding the market expectations. We have two indicators for measuring it. It's what the pricing is for the expectations of the market players. In many situations, it's misleading. And the expectations in the financial assets. The expectations aren't so straightforward. It's what should be balancing the actual market assets. We have to understand two different things. One way And the other one is how you perceive it. The interpretation also is due to their behavior. No doubt that the board is having its discussions. It's not a one-layered discussion, it's not so simple.
Բայց նաև շատ կարևոր է, որ հենց շուկայի մասնակիցները, երբ որ իրենց հետադարձ կապը պահում են, իրենք էլ լինեն ավելի, այսինքն այդ իրենց սպասումները արտահայտվի լավագույնս իրենց գնահատումները.
That's the expectations that they can best reflect in their assessments. We're looking at this, and as we do this, Vazgen, my partner, spoke about this. Whatever is being done, that's the change that is now reflected as transferring trust in expectations.
Framework-ի մասով հարց կար, թե ինքը framework-ը ճիշտ ենք մեկնաբանում, թե չէ, պարոն Սահակյանի ակնկալում.
Whether we interpret the framework correctly,
կատարումներով ինչ որոշում կայացրել, ես բնականաբար մասով չեմ խոսի.
and I won't talk about that. Mr. Sahakyan spoke about this, but I'll talk about how we should interpret this, our new framework, under our new framework, because it's new. We continue to work together.
Ինչպես պարոն Սահակյանը նաև ասաց, մեր նոր framework-ի ներքո նույնիսկ հնարավոր է
under the new framework, interest rates can be lowered, but managing A-type risks. Because if the market expectations are there's a clear pathway for the interest rates coming down. It's possible to reduce the risks faster for managing the A-type risks. And under that logic, reducing the 0.25. Hawkish. Some want to move it up, others want to move it down. All of that should start with the market expectations. But not the current policy interest rate, not the zero, not a certain level, the neutral. Our expectation, our starting point. In recent decisions, the board communicated the A-type risks gradually came from A-type risks to neutral, consistent with the market expectations. That's the scenario. What does it imply? For the logic of our policy, what it implies is that the board is considering it sufficient that the market expectations, in line with the market expectations, the policy interest rate is sufficient to meet the objective with the minimum costs. In the medium term, the policy in the trajectory is currently we keep saying this in Arzuman. The market's expectations for us, and you can see it's very important. We say there are lots of methods for how it can be assessed from the market, taking this interest rate from the yield curves, or try with different instruments to design it and to get some 1 year or 2 year expectations. But I personally am convinced that one of the best methods, and of course we keep working on this, on the alternative tools, on the expediency of these, Considering that in any instrument, even with the implied things, there can be background noise, and you would still not be able to correctly assess the interest rate expectations. There's the time premium. Are they stable over time? Are they not? Lots of other factors. So there must be some underlying judgments. We're saying maybe the best method is to ask people directly what they expect. It's to ask and for people to show you the history going back, and we don't take the presumption that markets will try to present wishful thinking as reality. That's not the presumption. Trying to manage that we want a scenario. It's in the medium term, the scenarios we want to have, all the developments, economic and other, because the policy interest rate expectations have to be consistent with it. Over time, we're trying to measure also when one bank came up with these expectations, or a market player, a financial market player, are these expectations consistent with what they're doing? So in the primary market, is this in line with their bids, or the transactions, dealings in the secondary market? But again, the presumption is that that's not the logic of the market players, that gradually their quality, that their seriousness will improve, and together we'll have a much better system and a much better mechanism. And a third brief one about the transfer mechanism. Dear Arzaman spoke, they said that it's not as effective, it doesn't work so well here. Without going into the technicalities, especially in this latest cycle, we could draw some conclusion that credit interest isn't responding well, or deposit interest isn't responding well at first sight. But the best indicator for measuring whether the transfer mechanism works is watching inflation in all countries. Whether we think that monetary policy or the central bank was not able to manage inflation. I personally deeply believe that we were able, and we've been quite effective in it. Even in the stages when global inflation was quite high, continues still to remain very high, our central bank, with its proactive action, managed to make inflation manageable for quite a long time up until now, which means that the transfer mechanism is working. Can't be that without. Only in Armenia it will stabilize. Whether we achieved this price stability at higher cost for society. Because our transfer mechanism didn't work so well. I deeply believe that is not the case. We don't see any evidence that we're more volatile than those in other cycles. Does it mean that, well, here's a final sentence, that the question is more about the cycle? It can be about a transfer mechanism in a cycle, so we have to understand what the problem is. Thank you. Two brief reactions to the framework. I understand that there can be situations where expectations would be created about the change in interest rate. But compared to the history of the Federal Reserve, the one-step reductions don't happen. It's always a 0.5 step. In terms of the relative impact, 0.5 is almost twice as big as what it is here. That's the context I've been trying to convey to you, so that we don't confuse the market participants either. some market players not to think that anyhow the central bank intends to quickly continue or pursue this policy. If you turn to inflation, the second part, from 2020, going back to your statements, from 2020, if you look at core inflation, it was mostly due to supply factors, some transitional factors, and foodstuffs importation factors, if I remember correctly. So we can consider them, by and large, one-off effects that were neutralized. And it's really not mandatory for the central bank, for them to have neutralized as a result of the central bank's policy, interest rate policy. That's another great question that enables us to elaborate on this. Starting from 2020, it's a really long time period. Uncertainty was extremely high back then in early 2020, COVID and so on. How the different central banks and the economies assessed the situation in the very beginning and how that assessment changed later is very different by countries. In the US, up until mid-2021, they said these are temporary impacts, that they're going to stop, so it doesn't make sense. Of course, after some while, it's also their assessment, and they haven't probably said it explicitly. They started to raise it sharply in early 2022, speaking about high demand in the economy, or high demand in the economy. Up until now, their inflation is 3%. It's still above 3%. And it's extremely hard for them to bring it down to 2%. Whereas Armenia's central bank, from December 2020, started to increase interest rates when inflation was actually below our target was still below our target. And we clearly communicated in the subsequent steps the stagflationary, the long-term inflation environment forming risks. Inflation was activating because of disruptions in value chains, with reduced supply and reduced demand, but the value chains were disrupted, as a result of which there were inflationary things. But then as a result of reopening, supply was much more limited, but demand was quickly recovering around the world, and probably also here. Demand recovering, speeding up, and in the global economy, the supply side inflationary pressures created expectations of permanent inflation, thinking this wouldn't be solved quickly. And if we also have the demand side factors, and here demand and demand side expectations and services inflation in early 2022 were coming close. They were declining very fast. Monthly inflation was already quite low. That was followed by the second big shock, which the US economy never had. We had another demand shock here. And we continued to respond and move up. Had we not contained this first shock, this new demand shock would have been a lot harder to contain, to absorb. So again, we went for a second quick proactive increase, and we tried to the extent possible to absorb that shock, because clearly the primary source of absorption was the exchange rate, which appreciated, but there were secondary effects also, the speeding up of domestic demand, and that's something to which we responded. We also managed to absorb it and to stabilize inflation at around our target, and then to reduce the target to 3% now. So all these activities are also giving us trust that we were able, as a result of these activities, to increase inflationary expectations and expectations towards the central bank. which for any subsequent activities or for the public would be lower expenses for achieving price stability. Thank you, Ignat Franken, C Quadratum Pega. I agree with Arzuman. I also dealt with different market players, and every single one of them said that this is not an expected reduction. It is our belief that your last 4 transparency reports were hawkish tilt statements, and it wasn't expected the interest rates would be cut. Besides, inflation came very close to the target from a much higher level. There's not much change on the right side. Plus, as a result of cutting reserves, requirement, lower interest rates there, the asset price transmission mechanism, wealth effects, some positive impact on the policy perspective. And with all of this in mind, here's what happened between November and December. That the majority of board members had the case-A scenarios replaced with more neutral or dovish scenarios, and the board decided that 0.25 percentage point reduction would take place. Thank you. Great. Well, we could say the following, really. With the latest decision, there were different opinions in the board. I mean, it gets published, but in a nutshell, and to compare this to the preceding one, the board's mood is now more that it should be neutral. And the change and the data that we get that gives us trust, some trust, is that the A-type risks, the impact, the magnitude, is now more compressed. And at the same time, there are things like we had a board member who explained his decision by the need to manage B-type risks. So there is diversity, there's pluralism. It's a situation in which the future will show how we move from this neutral position, where we're headed, and how the risk matrix will change. From that point of view, that's also my concern about the decision, but there's nothing there, it's transparent. I opted for not changing, thinking that it takes a bit more, it will need a bit more time. It needs a bit more time, not to, I need a bit more time before cutting it. So I would have rather it stayed unchanged. But in my mind also, I was presupposing some things might happen and the board could try to manage B-type risks or the opposite. That's the point. I mean, we're looking at the data, we're seeing the developments, we're trying to understand the magnitude of uncertainty. Any further questions? Edgar Agabekyan, Operat Investment Company. Adding to your views, your comments, but whether or not to reduce it in accordance with the expectations. In the market interest rates, we're seeing the reduction for a long time now. Lowering of interest rates, meaning that the market players expecting it in the midterm, in the short term. That's not what they were expecting. They were expecting a reduction later, say sometime next year. So that's just a comment. My other questions. What's the impact of reduced interest rates on the exchange rate also? Is there a possibility that it will somehow influence the exchange rate. Because for a long time now we're seeing some trends of the drum appreciating against the dollar. That's the simplest question, straight answer. With our policy interest rate, Edgar, we do not manage the exchange rate. It's not our target. I'm not saying it is a target, but will there be an impact according to your assessment? Well, that's more of a multi-layered discussion. That wasn't the focus of the board's discussion. The exchange rate path is one of the transmission pathways of monetary policy. Loosening of the conditions could lead to some depreciation of the exchange rate, usually. But, as Mr. Sagan said, there are many factors, many layers of factors, all influencing them. But it's important to understand the monetary policy position. Now, where is the neutral interest rate? Has it possibly changed in this time? So what's the monetary policy position here? Are we opening a gap or are we not? Or maybe when we reduce the interest rate, the gap could get bigger or smaller. It's not a straightforward answer there. But as I said, one of the transmission mechanisms, and it's fine and it's usual to expect that when the monetary policy interest rate is reduced for ensuring price stability, it's normal to expect that the exchange rate path is one of the paths and it should work. Go ahead, please. I have a question. Georg Nalbanjan, G&L Investment Company. This is general economic considerations, but the central bank is very lightly hinting that this year fiscal services changed a lot in the financial market and sharp interest rate hikes for financial and legal services. I'm sorry, but what's the question again? Could you clarify it? Audit and accounting. There's a 20% increase. It all became subject to VAT, these services. They're all now taxable by VAT, so all the services which the financial market was providing services to the whole economy, whether it's accounting or audit or legal services, they became at least 20% more expensive, all of them. So I want to understand what's their impact on our financial market overall. Has it been researched? If you're asking about the impact on financial market interest rates, no, we don't think there was a significant impact. What about prices? Inflation? If you mean the impact on inflation, nothing significant. It was very weak. We didn't notice it. It's not that we failed to notice it, but the reality was we needed to understand one of the factors of inflation. That was the VAT taxation of accounting services. Let me put it this way. Inflation in services, which is probably where it should have been reflected, especially in the beginning of the year, the month over month, we didn't see anything. Low rates of inflation, services and non-tradable sticky price index, very low. Did you see with the financial services payments going to other countries, this money not staying in Armenia? If it did happen, then the macroeconomic impact wasn't such that, for instance, from the point we would be worried from the point of view of macroeconomic policy. Okay, thank you. Any other questions, colleagues? Okay, then we conclude. No more questions. Thank you to all of you. Thank you. If there's anything else that you want to discuss informally, we're happy to stay.